Hi, I'm Neil Henderson, one of the general partners here at Nomad Capital.
And I'm Clint Harris, general partner with Nomad Capital. Today we're going over the 2024 Q4 storage market update. The U.S. housing market continues to shape the self-storage market. They are very closely tied together. We have reduced demand right now due to high interest rates and an effectively frozen housing market. Nothing there is new, although we are seeing a little bit of change. So we have some challenging housing dynamics and an oversupply in certain areas. And you'll have to forgive me. We got a lot of notes today, so I'm going to be reading off of this, some of this. So please excuse me for that. According to the American Association of Home Builders, the higher mortgage rates and affordability issues have caused the lowest home sales in 30 years. So over 56% of households right now are locked into a mortgage that has an interest rate below 4%, which is obviously limiting housing turnover and storage demand. So what we're seeing is even for people that want to downsize to a smaller house, their interest rate is going to be so much higher than it was just a few years ago that their monthly payment is likely to be $1,000 or $2,000 more, even for a smaller property. So you have people that are frozen in place because they have a record low interest rate and they're sitting on that equity because they're stuck in a lot of situations. We know that those top demand drivers for storage are death, divorce, downsizing, and displacement. Obviously, divorce and death are still happening, but the downsizing and displacement has definitely slowed. Because of that slowing in the housing market, we've seen a slow in the demand for new storage. Existing facilities are still doing great. It's those newer facilities during lease up, those number one demand drivers are slowing down. And because of that, we're behind the ball in terms of the lease up. We're also seeing that reflected in the rental rates. So tell me about how we've had a change in rental rate strategy.
Yeah, across the industry, one of the things we're seeing is a very aggressive pricing strategy by the REITs. So web rates for self-storage units dropped 15.5% year over year, but the in-place rents are actually 15.6% higher than average advertised rates. And this is basically what they're doing is what's called ECRI, which is existing customer rental increases. Some storage has always done, but the REITs are just doing it at a much more aggressive level now. They get you in for a cheap teaser rate, and then without telling you, they're just going to aggressively push your rates. And Nomad Capital is going to start doing this as well. The good news, bad news for people in the housing market is it means we're having a lot more renters in the market. And renters are 2 to 3 times more likely to use self-storage. And renters now make up 36% of the population, which should support some long-term growth for storage. Self-storage penetration, as far as the number of people using self-storage, has reached 10.2% of used households in 2024, and that was up from 9.3% in 2019. But new construction of self-storage has actually slowed significantly due to some of the market factors that Clint is going to get into.
Yeah, I'll dive into that a little bit more. But basically what we're seeing is these REITs are advertising rock bottom prices to get you in. After you're in, they're just focused on not that net operating income, but that occupancy. Once they get you in there, they know that they can crank up the rents down the road, and it's not likely that you're going to leave unless they hit a certain threshold. So we're seeing more and more of that. Because of that, we're starting to emulate that and try it out in different places as well, and that's something that we're constantly shifting on. The good news is there are signs of optimism. This is specifically talking across the market. The long-term trends are showing things like smaller houses, urban migration, and a growing rental population, driving optimism for sustained growth in the future. So the early signs of the housing market recovery did start showing up in late 2024. We actually had more household formation in the last quarter of 2024 than we did all of 2023. I think people are just coming to the realization that we're not going to get a 2.85 to 3% interest rate anymore. Life moves on, and at the end of the day, people are going to have to make a decision as to what's best for their family. You can't wait this out beyond a certain point. Because of that, the demand for storage is likely to rebound as those conditions stabilize. Homeowners and home buyers are starting to adjust to a new reality. In terms of the positioning and strategy, operational efficiency, what are some of the things that we're focused on?
Yeah, I mean, we're focused on the things that we can control. We can't control the nature of the self-storage market or the housing market right now. So we're focused on operational efficiency at each facility, making sure that we're running it to the best of our ability, making sure that our managers understand the systems and processes we want them to be doing. And we now have a regional manager overseeing a lot of our facilities. And then one of the things, the opportunity that's developing, again, we keep harping on this, is that there's been a lot fewer self-storage facilities built over the last 2 years because of the interest rate environment.
This is something I want to jump into because I think it's something that likely would skim over in a lot of situations. So the brass tacks comes down to this. Besides just constantly reading data and the reports and being on top of things and talking to our local managers, it's really important to us that we stay connected with our commercial brokers and find out what they're seeing in the industry. What's the trend? What's the sentiment that's out there? And so in terms of discussing market trends, the current insights, the overall feelings regarding individual properties and our portfolio as a whole, the advice is consistent across the board. It's sit tight. So we've created significant value in each of these properties specifically because of the conversion. Like we did these for a lot cheaper than you could develop them from the ground up. And while the market rates are currently down, there's noticeable excitement in the space in terms of acquisitions of storage facilities. So to date, we've learned about 8 private equity groups that since the election have put together new funds ranging from $50 million to $800 million that are specifically for the acquisition of self-storage facilities. So although occupancy and revenue are below historical averages, we have sufficient equity in each of our projects to meet our investors' return expectations. The demand for storage acquisitions is beginning to shift, especially under the new presidential administration. What we're seeing is new storage development has slowed down, right? We're in a higher cost of capital because of the interest rates. So a lot of developers stopped building new facilities. Now, we've kept rolling because of our lower cost basis. It's the reason why we love the conversions. And because of what we're seeing in the market, we're not stopping. We're quickly coming to a point where there's a lot of pent-up demand for acquisitions and people are going to be shopping and the demand is going to be high and the supply is going to be low because a lot of people pushed the brakes over the last year or two. So we're leaning into that space. So the deals still make sense. We're moving forward with our development to position ourselves as a supplier in a high demand, low supply market. So we're still facing economic headwinds with the challenges of our current properties, but everyone as a whole is still extremely bullish on storage. And as the housing market rebounds, the expectation is that all those historical demand factors are coming back as well. The broker's advice on this has been very clear. It's stay the course, right? So as long as we prioritize protecting the assets first, the investors second, and ourselves third, if we follow that approach, we're going to be very grateful that we did.
All right. I'm Neil Henderson, and this is Clint Harris, and this has been your Q4 2024 self-storage market update.